Hi, welcome to this very special edition, Reading the Rupee, a half-an-hour show that analyzes the currency fall from every angle. We have a power-packed lineup of guests joining us over the course of the next 30 minutes. But I want to very quickly start off by highlighting the top 3 questions that are on everybody's minds when it comes to the rupee fall. First and foremost is what has led to the rupee crashing beyond 70. So 70 was seen as a bit of a benchmark, in terms of a level that would be hard to break past for the currency. Many believe that from 70 the currency would have bounced back, but this free fall that has happened in a matter of a couple of weeks from 70 needs some bit of analysis and understanding. The second question is about the rupee trauma and how much more pain is ahead down the road for the currency, because the last significant fall from 70 to 72 has come by in pretty much a jiffy. So trying to understand, because that's the only thing that everybody on the street is asking, is how much more is there in store in terms of further pain and further unwinding and fall for the currency. And the last angle from an India perspective is, can the rupee's fall aid export growth for FY19? Can the benefits of a rupee fall be as immediate as to prop up growth in the export market, which then can balance out our situation when it comes to a swollen CAD performance in Q1, where the import bill was clearly a pressure point. I'll analyze all these 3 angles with our guests lined up over the next 30 minutes. I have Maithili Bisnormat, consulting editor, ET, now joining in on the show. Anand Narayan, expert in the currency markets and fixed income markets, also joins in with his perspective. Vivek Rajpal speaks to us from Singapore, representing Nomura, to analyze how he's viewing the currency fall. And then we also have an important voice from Moody's, Annalisa Di Chirara, giving us a perspective on how Moody's is viewing this development. Let me start off. Firstly, good evening to all of our panel members. Let me start off with our very first question. What's dragging the currency beyond 70? The options really can be threefold. You have the Q1 CAD numbers coming in at 2.4%. There is already estimate running that Q2 will look even worse because Q2 is when we'll capture the currency's fall beyond 70. Second is, of course, the emerging market universe facing a lot of pain, and the yuan included, seeing a fair amount of unwinding pressure. And last but not the least, this could be just part of a global trade where the dollar index is gaining momentum, and when the US starts doing better, it's negative news for emerging markets like India. Maithili, let me start off with you. How are you reading into the currency's fall? What do you think is the primary factor? Is it more local? Is it more global? Do we have a handle on things just as yet?
Well, it's primarily external factors, given the fact that there is an emerging market crisis led by Argentina and Turkey in particular. So there is a contagion effect. Of course, the US doesn't make things easier, because when the US economy does well, as you have said, it immediately raises the issue of interest rates, the hike happening faster in the US, and maybe the Fed getting even more hawkish than it is supposed to be at the moment. 2 rate hikes, maybe perhaps even 3, because the US economy now seems very close to overheating. But my sense would be 2 rate hikes. So primarily external factors. Of course, the fact that our current account deficit is worsening. The numbers that we saw for the first quarter weren't very good, and the second quarter is bound to be worse. So it is contributing to that, but I would say perhaps almost 90% of it is driven by external factors, 10% by our worsening domestic factors. But afraid when currency markets take fright, as they have taken now, it becomes very difficult to say when it will stop. Hopefully sense will return to the markets, but markets, as you know, are very often far from rational. Very often they tend to be very irrational, and when corrections happen, they tend to be overcorrections.
Right. Anand, do you believe that we are in overcorrection mode, and what would you attribute this fall to?
Well, actually, the one item which probably encompasses all the issues you mentioned is just flows. Look, for the last couple of years, the flows have been turning against the rupee. Our current account deficit expanded in FY18. It went up to $49 billion. Still, it did not impact the rupee because we had more than ample carry-seeking capital flows coming in, FPI in debt, exporter hedging, and so on and so forth, which compensated for all of that. This year, what's happened is that the core permanent flows have turned even more negative. People are now estimating current account deficit at over $80 billion. and carry flows, instead of coming in, are actually stalling because of the global context that Maithili just mentioned right now. So the flows is negative, period, right? And it's partly because of oil prices, but that's not the full story. Both last year as well as this year, the nature of the flows has deteriorated, and the reasons go well beyond oil. It's our exports being extremely tepid. It's the fact that we are guzzling smartphones more than we can afford. We're increasing our gold imports. We're not doing enough of Make in India or Make for India, all of that put together. So the nature of our external balance is looking terrible. And given the fact that the overall financial stability context isn't looking great, capital flows will be tough to come by. And until and unless we actually address those core flows, RBI intervention can buy us time, but it does not resolve the nature of our flows, and that needs to be addressed.
Right, Anand, stay on with us. Annalisa, how are you analyzing this situation? All emerging market currencies are suffering while US President Donald Trump refuses to end the rhetoric around the trade war with China. Nothing can seem to stop the US dollar as of now. Should we gear up for more volatility in emerging market currencies? Would you primarily say that this is a dollar-driven weakness?
That's right. I mean, I think we've seen a lot of volatility in the emerging markets here against the U.S. dollar. I think we've been focusing very significantly on our rated base across India and Indonesia, because those, of course, are two of the currencies which have been most volatile over the last couple of weeks, and trying to understand the implications of such volatility for some of these specific industries and sectors that are heavily reliant on either U.S. dollar debt or actually can benefit from the U.S. dollar revenue flow coming from this volatility.
It's $1 million question, really, on what happens with the currency markets, because it's also, taking Anand's point, Maithili, it's a very liquid market where, volumes are pretty brisk. So the swing can happen any which way, as you pointed out in your earlier answer as well. The next question that comes to one's mind is how much more to go? How much more pain is in store? I know you were propagating a weaker currency at this point in time, but did you expect this much weakness?
Well, not really. And more than the quantum of the decline, it is the pace of the decline that is a little worrying. And frankly, for this, I would hold both the government and the Reserve Bank of India responsible, because they allowed the currency to appreciate much more than was warranted by the fundamentals, which is why you find the rupee is actually depreciated much more in the past few months as compared to other emerging markets whose fundamentals perhaps are much worse in India. Of course, leaving aside countries like Turkey and Argentina, we have depreciated more than other currencies in the past few months as compared to, say, the Indonesian rupiah, the rand and the real. So given that, I think it's the part of the reason is because the rupee was allowed to appreciate so much more than was warranted. Had the Reserve Bank of India allowed the rupee to find its more correct value over the years, past 2 or 3 years, then we would not have seen such a rapid decline. So the adjustment was necessary. We're very close to what the fair value would be, but the pace of that decline has been much too rapid. And just to be asked, just 2 little plus points, Tanvir, at the time when we're kind of talking about all the dismal scenarios, there's one very fundamental change in the structure of the financing of our current account deficit. If we look at the Q1 numbers, you'll find that actually we've got more foreign direct investment than net portfolio investment. Now, this is a very welcome shift in the kind of financing. Remember, this was why China was so much more successful, because they were getting their reserves through foreign direct investment, not through portfolio flows. We were getting it through hot money flows, and that is a very dangerous way of financing your current account deficit, because it's easy come, easy go. So now we're seeing that structural shift, and if that continues, then we need not worry every time our current account deficit goes towards dangerous territory. Whenever you're dependent on portfolio flows, particularly debt flows, it will be very dangerous. In fact, what we're seeing right now also is that debt funds have pulled out much more than equity flows. So in terms of preference, it should always be foreign direct investment, followed by portfolio flows in equity, and last of all, portfolio flows in debt. Unfortunately, we did exactly the other way around. We had maximum inflows in debt last year, less in equity, and earlier we used to have much less in direct investment. Now we're seeing that welcome change, and that, if it continues, we should be in safe territory. In the interim, there will be some pain, and we're going through that.
Okay, That's a very interesting point. Anant, do you sense that with a large chunk of the debt inflows reversing, that, we might be towards the end of the currency fall that we're witnessing right now? Or, to the earlier point, if the correlation is so strong with other emerging market currencies, then, till there's stability in the region per se, we're not going to be looking at our rupee defending any of the current levels.
And Supriya, look, the basic flows still look negative, right? If you're looking at $80–85 billion of current account deficit, even if net FDI improves from $30 billion to $35 billion, maybe even $40 billion this year, which is very unlikely, we are still looking at a core deficit of $40 billion, and that's not going to change in a hurry, which means we are still looking at a situation where we are looking for slightly more hotter money, like Maithili was saying, to fund our basic core deficit. Now, there is a silver lining, the fact that RBI has accumulated huge amount of reserves over the last few years, and therefore at $400 billion, it has ample firepower to manage short-term volatility. Now, should rupee depreciate further? Put it in context, in the beginning of this year in January, rupee by the real effective exchange rate terms was 21% overvalued. Now, there's been a significant correction since then, and we're about 12–13% overvalued currently. Now, if an economist was to argue that, let it react even more and go up to, let's say, 73, 74, 75, etc., that's a tricky situation. You don't want, like Maithili was saying, you don't want too rapid a correction causing panic in the market. Don't forget, there is an overhang of unhedged positions in the market. There are people who have ECBs which are not hedged. Importers have not hedged. There's still $60 billion of FPI in debt sitting inside the country. You don't want all of them trying to get out at the same time. That can be absolute panic. So it's important to balance an RER correction with the lack of panic in the market and making sure that it's all orderly. Now, also, a correction in rupee, yes, will impact and improve current account deficit over a period of time, but it takes a lot of time. There are other factors that are dogging our current account deficit, and I mentioned some of them before. Our exports are struggling. Our love for smartphones and the fact that we import all of that is killing us. The fact that we're importing a lot of manufactured trinkets from China and our trade deficit with them is about $65 billion, is killing us as well. All these need to be addressed. Somebody has to sit up and take notice and say, listen, we know there's a problem in manufacturing, in exports, in import substitution, in Make for India, and we will address all of them one by one. And there are lots of suggestions around that. So to me, we've got to use RBI's reserves at this point in time. There's been a healthy correction already. Let there be no panic in the market. There is no need for panic. But with the time that RBI can purchase for us using its reserves, we have to set our house in order, make sure financial stability is corrected, and make sure the core issues around the current account are addressed.
That would be reassuring for our viewers tuning in right now. Alvin Tan, Director of Foreign Exchange Strategy at Societe Generale, also joins in. Alvin, my only question to you, since you're a strategist, is how much more to go from 72? What's the next target that you see on the currency?
Hi. Well, the situation with the rupee, of course, quite apart from what's happening in India, it's hard to divorce it from obviously what's happening to EM in general and globally with the Fed raising rates and the dollar stronger, particularly against EM currencies. Now, in terms of where we are looking for it to move, we have a forecast of the Indian rupee at 73 by the middle of next year. So the medium term is, in our view, is further upside in the dollar Indian rupee rate, but quite moderate. But I do think that there is a lot of risk that the 73 target will be broken through in the near term, meaning in the next, say, 3 months or so. And again, that comes back to the global backdrop of a situation where the Fed is hiking, where crude oil prices remain quite elevated, and we have escalating trade tensions, particularly with U.S. and China. And all of this point to higher upside risk to Indian rupee beyond 73 in the next 3 to 6 months.
That's valuable to know. Alvin, just stay on with us. I'll urge all our panelists to be with us through this break. When we come back, we'll essentially talk about what we can do to take advantage of this currency fall so that it doesn't impact our macros in the long term. In a bit. Welcome back to our special show analysing the rupee's fall, reading the rupee that is. My colleague Rituparna Nath joins in to give us a quick sense of what the government is feeling about the currency fall and what they're doing about it. Ritu?
So the government is worried about the depreciation of rupee. We've been given to understand from top finance ministry sources that but however, although the government and the RBI are in regular touch and they're definitely very worried about the rupee and they will be intervening as and when they feel the need to do so. But the market should not become panicky about it. They should not be get into a panic mode, and they are exploring several options like compressing the current account deficit or exploring the scheme, the deposit scheme for NRI. So all of these are being explored by the government, and they are also in regular touch with the RBI. So both of them are exploring options, and they will intervene into the situation as and when they feel the need to do so. Another factor about this is oil prices. The government is also keeping a close watch on that as well.
Thanks, Ritu. That's not telling much. Maitli, all this talk about, this theory about the rupee's fall will help exports. It's not like it's going to happen overnight. Right, we have a higher import bill than export revenues at this juncture, and we import a lot more than we export, like Anand was just mentioning a little while back. How much time before we can actually see this competitive advantage playing out for our balance of payment situation and thereby the CAD?
Well, Tanvir, the exchange rate is only one factor in determining export competitiveness and export performance. A very important factor that determines how your exports perform is global demand. And when you're going to see these kind of trade tensions and trade wars, that doesn't do very much for global demand. So it's really not easy to say, when are we going to see this? It's very difficult to predict a timeline. Certainly, a better valued currency in terms of more realistically valued exchange rate does help export competitiveness, but that's not enough. We have a lot of other issues in terms of ease of doing business, it's higher interest rates, etc., GST on export, getting refunds. So a lot of problems which really do translate into affecting our export performance. On the import front, given that the bulk of our import bill does come from oil imports, which are almost completely price inelastic, there's very little that we can do. But the hope is that if the rupee depreciates as it does now, it does make import of other items that Anand mentioned, in fact, electronic items, gold, etc., more expensive. Now, these are more demand elastic. So to that extent, we might see some shrinkage of our import bill and some increase in our exports. So together, that should help bring down the current account deficit marginally, even though at the moment that doesn't look like it's going to happen very easily or very quickly given the way oil prices are. But if the current account deficit comes down marginally and at the same time funding becomes a little bit more correct, as in terms of more direct flows rather than in portfolio flows, hopefully things should not reach such a situation that the rupee really goes into free fall. Because mind you, even though this is EM contagion, our macro fundamentals are far better than they were in 2013, far better than that of many of our peers. So hopefully sense will prevail in the market, and I think the government and the RBI are doing well to kind of try and sit it out, keep their nerves and say don't panic. At the moment, there's no cause to panic.
Yeah, that's, I think, the universal message that's going out. But Anand, again, on that argument, because since morning, every time we touch upon the rupee story, everybody's talking about IT, pharma, electronic makers, scores of sectors that can benefit from the currency's fall. But at a time when the yuan is also getting devalued and other emerging market currencies are also getting devalued and are perhaps falling significantly, what kind of competitive advantage does it offer India? Where are the exports and when will they come through?
Well, for a change, I tend to agree with what Maitli said. I do think there will be a positive impact on the current account deficit over time, compared to where we were with an extremely overvalued rupee. Having a less overvalued rupee will definitely benefit. But as you rightly pointed out, Supriya, it will take time. It will not happen overnight. Also, a very sharp move sometimes can be counterproductive. It can actually hurt importers a lot without giving too much of benefit to exporters as well. So it's a bit tricky, but besides currency, there are several other issues which need to be addressed. Take the example of ready-made garments, and I know it's a complicated sector, but we've been seeing degrowth for the last 2 years at a time when Bangladesh, Vietnam, Philippines, Sri Lanka has been seeing double-digit growth. In fact, in absolute terms now, Bangladesh is higher than us in ready-made garment exports. We have Indian exporters actually closing manufacturing in India and setting up factory in Dhaka. This is completely bizarre. So there are several issues on export, on local manufacturing, on infrastructure, on financing, the impact of GST, which needs to be addressed. There are several suggestions coming in from industry experts on what can be done to help that. As long as the government acknowledges that and starts to work on it, on ease of doing business for all these sectors, I think we will make progress over time. I think the demand reduction will happen and exports should be doing better as well. For all this talk of trade wars, global trade is doing reasonably well. And frankly, if China is under trouble because of the trade wars, we should be filling in the breach and stepping in and becoming a supplier and a provider to the US instead. So we should be taking advantage of that. Last bit on this, government intervention and coordination with the RBI. If you want the market not to panic, frankly, the amount of noise that's coming out from Delhi should reduce. And maybe for a change, Mumbai should start talking a little bit more. What we've seen is a lot of noise from earlier we were told that everything is hunky-dory when Piyush Goyal is there.
Sure.
RBI sold $25 billion to protect 69.
Yeah.
And then after the Turkish lira blew up, suddenly it became, nothing wrong with the rupee depreciating, and that's why people are coming in and buying right now.
That change in stance,
reduce the noise level, give a sense of what you intend to do, absolutely. Give a sense that there's nothing really to worry about. And by the way, we know what the issues are in terms of exports, in terms of imports, in terms of infrastructure. We will address them, and we will address them over time.
I'm just running out of time. I need to get closing comments from Vivek Rajpal, India fixed income strategist at Nomura, joining us from Singapore. Vivek, I know you've come in late into the discussion, but why don't you close it out with your thoughts on how you're seeing this currency fall, within the EM universe, and more importantly, it comes at a time where there's either ways this differentiated trade when it comes to rates globally. Incidentally, we are also looking at a multi-year high when it comes to the yields at 8% plus. So how do you correlate and join the dots as far as the macro story goes in India?
Right. So I think Anand has covered all the points. I think just one point from my side on rupee is that it's not I think it's not about the level, but it's about the pace of depreciation, which is probably worrisome. And I think, yes, weakness in rupee can be beneficial to exporters, but if the pace is too fast, then it can be very counterproductive. And therefore, I think what worries me is the pace of depreciation. And if it slows down, then probably it will be providing comfort to the markets, and to a certain extent, it will have some beneficial impacts as well. Now, as far as rates is concerned, I think because of the pace of depreciation, what's happening is that market is getting worried about implications of weakness of currency on monetary policy. Though our fundamentals are very strong relative to 2013, I mean, let's not forget that we are in a tightening cycle. And from that perspective, market is worried that whether at some point of time currency weakness will result in a significant more monetary policy tightening than what was assumed earlier, which is why bond yields are reacting. And I think if you really see FPI flows have not been favorable, and I think that's mainly because of the total return perspective and monetary policy implications of weaker INR.
Right. Thanks very much to all of you, Vivek, Maithili, Anant, and Annalisa. Thanks very much for joining us and helping our viewers understand this currency fall. Yes, the pace of the fall is worrisome, but as of now, I think in the very near term, we're watching out for how quickly does the rupee get to 73. then perhaps the dynamics would change, and the headlines also with regards to the rupee's impact would take another course. But for now, thanks very much for watching this special edition. Hope you benefit from the show.